Welcome to the UTI Swatantra series powered by ET Now. This is an investor education initiative. Like you know, we've been helping you understand the process of investment. And today we're going to talk about how to choose a financial planner and how to find the right planner for you and for your family. There's an audience in the studio who have a lot of questions for us. For a quick round of introduction to our two guests. Sangeeta Zaveri is a certified financial planner and the joint secretary of the Foundation of Independent Financial Advisors. Yogesh Sharma is the director of YS Capital and he's a founding director of the Foundation of Independent Financial Advisors as well. Both of you, thank you so much for coming in. We've talked about a lot of things up till now, but in every episode, how to choose a financial planner keeps coming up, which is why we thought it made sense to have this episode. Sangeeta, tell us this. There's a lot of difference right now between an advisor and an agent. Can you tell us what the difference is between the two?
Basically, an advisor is a person who takes you through the entire goal-taking process. What are your goals? Whether it is retirement planning, it is children's education, it's marriage, it's a vacation. It could be even doing your wills. So it is a longer journey. He's not just going to be advising you which is the product that you have to purchase. Whereas as far as the agent is concerned, he is just a transaction-oriented person. So he will just make you do a mutual fund, for instance, a mutual fund investment is concerned, he'll just do your investment for you.
And Yogesh, how do I decide whether I need an agent or I need an advisor?
Basically, it all depends on the knowledge base that you have. There are certain people who are already well defined in what they want to do. I mean, they've already got their insurance done, they've got their will, they've got their taxation done through their CA. And they specifically want to invest, let's say, in an equity fund or in equity. So they can go to a particular agent for transaction service and say, I need to invest in a certain equity fund. Can you do that for me? Or he can maybe ask him, okay, I need to do in a specific area of equity, like a large cap or something, and can you give me options? And based on that, you can do that.
All right.
So it all depends on the knowledge base or skill sets.
Also, is there a difference in the cost between the two services?
See, if it's a registered investment advisor that you go to, then he cannot charge you for the product that he is advising you on. So then he charges you for giving you the advice. Whereas the agent, his remuneration is based on embedded in the cost that he's giving it to you. So that's a call that one needs to take on.
So if for an advisor, I pay for the advice.
That's right.
And if I'm using an agent, then he gets compensated by the producer of the product.
That's
so
right.
The mutual fund company will compensate him. I don't have to pay him anything over and above. The other thing, Sangeeta, that's interesting is that there isn't right now a set fee for advice.
Yes.
It depends on advisor to advisor. So as a customer, how do I decide how much I should be willing to pay for advice?
Well, that depends upon you and your advisor. It depends upon what sort of a comprehensive planning that you are getting it done. If at all you are engaging him not for a particular advice only, but he is going to take you through the whole risk profile. He is going to manage your cash flow. He is going to also assess your insurance requirement. Then he could be doing your Mediclaim, etc. So, and the amount of time that he's spending with you. Then I suppose that you have to decide the amount of payments that you do accordingly. So there are different types of models also in that. It could be just one-time fee. It could be a flat fee, a flat fee. It could be a retainership. It can be depending upon the AUM that the person is handling. So there could be different fees, but then it depends upon sitting down with the person and then deciding what is the fees that you have to charge.
All right. Okay, I want to open the floor to some questions. There's a gentleman in the front with a question. Go ahead. Yes, sir.
I'm a retired person. I invest only in debt mutual funds. Now, I have selected also a very good advisor who manages everything. But at the back of my mind, I always think that every time we make an investment, is it the right investment or not? Is it because of that fellow's time paucity or his people's lack of knowledge or lack of proper marketing research, whether I'm doing the right kind of investment? That's always at the back of my mind. I don't see any website where you feed in the data what you have invested and tells you, okay, had you invested in somewhere else, you would have got a better return. Basically what I'm saying is there's no means of performance evaluation of your investment through the advisor. Thank you.
Yogesh, do you want to take that? How do you evaluate your advisor's performance? How do you know whether he's giving you good advice?
Trust is a very important factor in choosing your advisor. You need to have that trust with your advisor. And there where I can see there is a deficit on that. First, you got to know that he knows what you really want out of it. And based on that, then he has chosen a path after discussions with you, after showing you multiple options that are available. So if your advisor has not done that, that's where your query has come as to if I had not done this, then what would have been there? He should have taken you through the gambit of all instruments available for your needs. And you all could have jointly come to a conclusion on which product to take and then gone forward. Past performances are never guaranteed for future. I mean, nobody can say that just because this was chosen for this specific reason and on anticipation of this return, it could have gone. It may or may not happen that. See, the main important part is a lot of people look at returns like you say, sir, but if you see most of the surveys, they say that the whole experience of investment, one of the very important part is the financial advisor. Who is a financial advisor plays a very important role besides getting the return. Who is a financial advisor and what relationship you have with the financial advisor.
Yeah, we have a question here in the front from the lady.
Good evening. So what should be the best criteria for choosing a financial planner?
I would say first thing to do would be to take reference from friends and families. But like I always said, that you need to be very comfortable with the financial planner or the advisor that you have chosen. Ask around, ask your friends and things. Go on the internet, there's a lot of information available. Ask for what kind of certification he or she has and what kind of people they deal with and how do they deal with. Please do all this research before you go and choose a financial, because the cost or the person is not the only criteria. So,
yeah, Sangeeta, I want to bring you in here. One more thing to add to that is that, so there's one thing where I look for qualification, I look for, references. I also want to understand experience, because there are some people who've been in the market for 10 years, for 15 years, for 20 years, and there are the younger ones who've just come in. How important is experience, and, should we be looking for someone with a certain level of experience if we're looking for a financial planner?
Yes, certainly. I think experience is the most important thing. I mean, today when you go to a doctor also, generally you go to a doctor who has a lot of experience, because obviously you feel more comfortable. So experience certainly is the most important thing. People who've been there for 10 years, 15 years, you will be more comfortable going to that person because he's seen ups and downs in the markets. Because if finally the person is going to be investing into either debt or in equity, so yes, I suppose experience is one of the most important things. So, integrity is also something that one will have to see.
All right, so integrity, experience, references and availability. We're going to take a very quick break. When we come back, we'll talk about qualifications that your financial advisor must have. Welcome back. You're watching the UTI Swatantra series powered by ET Now. We're talking about how to find the right financial advisor, and we have a lot of questions from our audience members. Yes.
Yeah, hi. What are the different types of financial advisors in the industry?
Basically, there are two kinds of financial. One is the SEBI registered investment advisor, where you have to register with SEBI, and they are the ones who typically charge a fee, and they cannot take any cost or any remuneration from any of the product that they sell. Okay. So that is one. And then there are the advisors who will advise you on your investments, and their basically remuneration is built in on the products that one they recommend. So if they've given you a mutual fund product, their remuneration comes from the product. If they've given you an insurance, their remuneration comes from the insurance. And within the registered advisors, then you basically most of them are planners, and who will guide you on the entire process of planning.
I want to come back, and we talked about experience and qualification. I want to come back to integrity. Now, it's hard enough to judge someone's, success rate, but how do I decide whether this person who's come to meet me has the integrity to handle my money?
As Yogesh was mentioning, there are products that a financial planner, he does not charge, okay? But there are some of these institutional brokers. They have two arms. They have one arm which is doing the financial planning, and there is another arm which is doing the transaction. Now, sometimes what happens that if at all they are trying to sell a product, that means there are certain additional brokerages maybe which they are getting, or it is possible that the bonuses are dependent upon that. So if at all they are trying to push those products, that means you can understand that there the integrity is not involved. What you have to really see that is the financial planner is only looking at only what your goals are going to be are to be achieved. Is he only looking at that? That is the most important thing. So your integrity will come into play at that point of time.
You should have something to add to that? If I'm judging integrity of my advisor, how do I judge that?
No, like I said, the first part would be if you can get someone with a reference. Or if you don't have, first ask the person, give me some references of your clients who you have and do it. Because whatever I may say, ultimately, I can say a lot of things, but you need to judge for yourself. Ask the right pertinent questions to the person. What is it and why would you do it? What is your remuneration? How do you earn? What are the goal sets? And after a couple of sittings, I think you will get through it. Look at the background of the person, how long the company has been for. I mean, everything is available on the internet today.
Also, as customers, we're allowed to ask an advisor or an agent, what is your commission on this product that you're
That's
selling?
what I said.
That's a question that everybody's allowed to ask, and we should. The gentleman at the back.
I think we talked about this earlier. This is regarding the trust. How do I trust a planner?
Keep coming back to this. Is there a trust deficit for financial planners in the industry?
See, a planner will sit with you and discuss with you as to what your goals are. So there is not so much as trust about the planning part of you. It's more on the execution part of you. As why is he taking me on a path which is really not what I was intending to do, or what is his intentions on that part? The other good question is he listening to me or is he telling me what to do? I think that's a very important criteria that you all should judge. When 1 or 2 sittings with a person, you'll know that is he listening to what I want, my goal based, what is my risk. 2 people sitting next to each other would have the same goal, but you would be completely different in how you perceive risk versus how somebody else perceives risk. How long, what is their age criteria? How do they do that? You need somebody who can really understand that, and you will know that. One moment you talk to somebody, and you will know that, yes, he is the right person for you, and then you have to go with that. I mean, there is no other benchmark.
I think the trust is something which happens over a period of time. Once the data collection, etc., takes place with a financial planner, and you go along, and once you see that he's achieving one after the other goal, I suppose the trust gets built over a period of time also.
My question is, once I trust that planner, okay, now generally what is the current trend, like we have to decide about paying the consulting fee, or it should be like one way or a milestone we have to pay? How general trend is in the current market?
Some people have a fixed pay. They say we charge on when we do your plan and for execution. Some say we do it on the total AUM, that is total assets under management. I mean, whatever they are managing for you, they charge a fee on a yearly basis or on a transaction basis. That is something you need to discuss with individual planners advisors that you are basically looking at. Each one has a different model. Some may say, no, this is our model and this we don't deviate. Some say we are ready to deviate. We have 3. You decide which model works best for you. Each one will have to decide which one has to do. So if you're one that's doing a lot of transactions, you may not want to go for a transaction-based model. That means every time he executes something for you, he charges you a fee. You will say, no, maybe I don't want to do that. And I will instead say, okay, give me a fixed fee for the whole year. So no matter what transactions I do, it's covered in that. It all depends on individuals.
There is a risk also with transaction-based model where he might encourage you to do
exactly.
more transactions than necessary, right? So should I be automatically worried if he's asking me to make a lot of changes in my portfolio?
Again, there comes to the trust deficit.
Yes,
Why do we always assume that the person who's saying it is saying something which is not correct for you? See, ultimately he needs to be in the business. If today I'm going to give wrong advice to one of my clients, he's going to say to 10 other people, right? So we, in fact, in our line of business, are much more careful as to what we are saying, what we are recommending, and what we are doing, because our whole business model is based on trust and integrity.
I want to ask you this. There are 2 choices here. There's the entire corporate setup, because there are big companies right now who are in the business of financial advice. You can find an advisor either through your bank or through one of the larger securities companies. Or there are independent financial advisors, individuals who will come and meet you. How does a customer choose which one I want to go with? What is the difference in the service?
Generally, people have more trust in the individual financial advisor because he is able to give them more attention. Today, the institutional setup, the people who are managing it, those will be individuals. Again, individuals who may not be staying in the company on a regular basis because the plans are made by the people who are working over there, and those people would be changing their jobs also. So generally what happens is the plans which are made, these are long-term plans for whether it's for your retirement, your child's education, your vacation planning, or whatever be it. So generally we have seen, and it is world over, it is the individual financial planners are the people who get more business than the institutionalized setups.
All right, the gentleman in the front, go ahead.
Do advisors do a written contract with the investors?
It's an excellent question, actually.
Yeah. See, if you go to a planner, yes, definitely, he'll make a plan for you in terms of your goals and what you have discussed, and then it's a written document which you both sign on. So, and then based on that, yes, then you go ahead with that. So there is a agreement on that. But if it's somebody that you are just, saying to execute something for you, then you just basically have him execute it, and then depending on some people, they have correspondence and where you have to give it in writing that I want to execute such and such investment, and then he does it for you.
But what does the SEBI say? Do we need to have some kind of a legal agreement between the client and the advisor, and based on which then I can go to SEBI in case I'm not...
You can always go to SEBI whether you have a written or not written thing. You can always complain about mis-selling to SEBI, and SEBI will look at it very, very seriously, and it has done in the past too.
Well, what is the means for redressal? Is it the SEBI website? Where does one go lodge a complaint?
It is SEBI website. It is there, and SEBI is quite, they respond quite quickly on that, because they're very sensitive towards investor concerns, especially on any mis-selling. They're very sensitive to that.
All right, we have to take a very quick break, but when we come back, we'll take more questions from our audience. Don't go anywhere. Welcome back. You're watching the UTI Swatantra series powered by ET. Now we're talking about how to find the right financial advisor for you and how to judge the performance of your financial advisor once you've found them. There are, of course, a lot of questions to answer from the audience. Go ahead.
When we invest, we give away a lot of sensitive information, my earning, my family earning, etc. So what is the legal protection from data privacy that the planners or the advisors, the agents are really working with us?
The planner that you have, you should insist on a written contract where there is data confidentiality from the planner that he cannot disclose any of this information to any outsider without your permission. That should be part of a contract. That's what I'm saying. That should be part of the contract that you're signing with your advisor.
Sangeeta, is this industry? No, but is this an industry norm at this point?
It is an industry norm as far as the data confidentiality concerned. It is always a part of the contract.
All right, so it is a part of the contract. The gentleman in the back, go ahead.
Hi, we discussed now about trust, about integrity, but there are other questions generally in the people other than HNIs and general people, that how much should they pay to the advisor and why should they pay?
See, there are three things of any financial product: risk, return and liquidity. Now, it is not possible for a person who does not have enough knowledge that where does he allocate this money and how much amount should he allocate in different areas, right? Now today he has to go to a financial advisor, otherwise what will happen? You will do your own allocation. It is possible that you will buy into a product which will give you suboptimal return, or you will buy into a product which will be high cost to you. So it makes more sense for you to go to a financial planner, and it is better to pay the fees. It will more than take care of the returns that the planner will make for you.
So an average, so assume I'm talking to a financial planner who has 5 years experience and he's looking after everything for me, from the mutual fund to the insurance to fixed deposits to my larger plan and my larger goals. Ballpark, what should I pay him, flat fee, annual, what would be the average fee in the industry right now?
Actually, there is no standard as of today, but the basic point is that in India, people are very wary of paying financial advisors any fee. Today, when you go to a doctor, do you ask him what is the fee and then you go to him? He's an expert, you go to him. Similarly, any person today, he will ask, depending upon his establishment cost, he has some establishment cost, he also wants to make profit. So accordingly, he decides that what is it that he wants to charge.
See, that's why, the products, a lot of these advisors who are basically getting remuneration from the products are much more successful because of the same reason. And then you don't have to worry, right? SEBI has put a mandate on the cost of the fund that they can charge per year.
Perfect.
So the person who's going to get is going to get. So that's, let's say it's 1.25, 1.75, whatever is the cost of the product. If it's 1%, he's going to get a remuneration out of that. Perfect. So he's definitely not going to get you 5% from you.
Correct.
So he'll definitely get something less than that because the manufacturer has to keep something for themselves and then they can come in.
You said SEBI has given a guideline of the brokerage which is maximum payable to the brokers, isn't it?
No, I said the fund is allowed to
fund is allowed to give certain amount.
Yes.
But if you make it as a standard figure, as a percentage, then you won't have a doubt whether he is trying to push one product or another product within the same category. And this can be a transparent number.
The cap is already decided by SEBI on what you can pay. And those caps, if you see, are so minimal that within that cap also the fund houses themselves, the manufacturers themselves have to take their cost of the thing, and then they share a certain portion of that.
So, as someone who distributes mutual funds, what is the range? So, if the maximum that a fund house can charge me is 2.5%, within that, there's the fund manager and his entire team, there's the marketing costs of the product, there's the printing costs of the product, there's the processing, and then there's the commission. So, what is the range in which a commission can, from the maximum to the minimum, between 1 to 2%, what's the maximum range it can
this 2.5 also is on the upper side, because most of the fund houses are much lower. The expense ratio is 1.65, 1.75%, and out of which, like you said, they have to take their own costs of that, and these are equity funds, so the debt is even much lower. So, a person can get anywhere paid between 0.05% to maybe around to 1.5% is what he can get paid for doing that service for the whole year, and that goes on for the whole year. It's not that. And some of them, there are different models. Some get it up front, some get it over a period of time, and that definitely is also, it's on the way going downwards, because each fund also then wants to perform better, right? Mm-hmm. The higher that he charges, you got to remember one thing, that if I have a 10% return and I as a fund house is charging 3% or 2.5% that she says, then that goes minus the return. And if I'm not going to give the return, you're not going to give me the money in that fund house. So it is in my interest to bring the cost down of charging my fees, which in turn brings the cost down to the person who's being paid for it.
Can they not be transparent and give
it is transparent, sir. It is all available. If you go on the website or you go to the fact sheet of every fund, the expense ratio is clearly mentioned to them.
I'm a teacher, so generally from the market, all those rumors are spread regarding the mutual funds, and students, when I teach them, they feel as that this thing is not a part of their life as a science student. And when they reach to an age of 30, 29, because the science studies are so long, and there they decide that how should I pursue an advisor, planner, and there also they get demotivated because of the rumors spread of wrong results. So how should I motivate them?
That's a good point, and we've brought this up in previous shows. The fact that for a lot of kids, school or college, there is no financial education at all. And then when you start working and then you spend the first 5 years just spending your money, and suddenly at the age of 30 or 32, you say, oh my God, I have to start investing. And then you realize you know nothing, and then you have to start from scratch. Is there any way, and I'm so glad you brought this up as a teacher, is there any way to start off children young?
See, a lot of these investor awareness programs are happening, which is being mandated by SEBI also with all the fund houses to go out and speak on that. And I would urge all the educational institutions to make it compulsory for students as part of their curriculum to know something about investments. And like you rightfully said, the best part is to start early. I mean, it's something like a systematic investment plan, which I'm sure, that's a certain small amount that anyone can put every month, which everyone should start. Most people, after they have, started, spend their money and then later on realize. But even that 5 years difference, had they started 5 years, what would require 5,000 would even require much, much less amount. Because the earlier you start, it's amazing, what small amount you can save to get the same goal met than when you start later on in life. But we don't have that system in our education.
As a teacher, can perhaps tell your students also that one maxim for a finance, that it is not income minus expenditure is equal to savings, but it is income minus savings is equal to expenditure.
Unfortunately, on that note, we've completely run out of time on this show. Thank you both of you for coming in and answering all of our questions. You've been a wonderful audience. I'm so glad you spent time with us this evening. And thank you so much for watching. Remember, you can reach us on indiainvestkaro.com, or you can send us a question, tweet it out, #InvestKaro. Thank you for staying with us.
Brought to you by UTI Mutual Fund. हक एक बेहतर जिंदगी का. Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.